Hello friends, welcome to my channel The Risk Management Research. I am making this video after a long time, maybe possibly after a month's time. And this time I am bringing to you is a loan insurance mis-selling. What is this is about? Through this video, I want to create awareness among the audience about some of the prevailing practices of loan insurance mis-selling. This is especially for those who may be taking loans from any financial institution in future, such as bank. And I want you to be aware of what you are paying for and its purpose, because I have been deceived twice in last 10 years. So I want that the risk for you to be reduced, and that's the purpose of this video is. Let's move on. What is insurance mis-selling? Insurance mis-selling is an insurance policy. Mis-selling is selling of insurance policies to the customer that do not meet its need. See, any insurance policy that is being sold to the customer has got a purpose. It is going to meet the needs of the customer, and if that need is not met, then it means that that particular policy is not meeting its need. And this typically due to the incomplete or misleading information provided by the seller. And what happens that the intermediary between the insurance company and the customer, these are generally the agents or banks or any financial institution which is sitting between the customer and the insurance company, that create the mis-selling platform. The intermediary between the insurance company and the customer follows such practice, misleading and selling what they want to sell rather than the customer's need. That is what the mis-selling is about. And it is important to understand what the mis-selling is before we get into what the issue is. So I was searching about, what are the prevailing press, clippings on the mis-selling, and I got that recently in September. The mis-selling, one article saying that mis-selling of life insurance policies at alarming level, says IRDA. One of the IRDA officials speaking at one of the forums and had stated, this paragraph. The insurance regulator and the development authority of India said that complaints about the product mis-selling in life insurance has increased to an alarming level, so much so that it has grabbed the attention of the policymaker. So that's the level of the mis-selling it is. Mis-selling was prevalent right from the beginning. It is still there, and the regulator is trying their best to reduce it. The purpose of the video is to ensure that you understand what the mis-selling is and possibly take the best corrective action. So what is loan insurance? So let's first understand what is a loan insurance, then we can go into what is a loan insurance mis-selling. So the purpose of the loan insurance policy is to protect the value of the loan for the lender, which is often the bank, against the mishappening of the loan seeker, often the customer. If somebody who is going for a loan, a housing loan, to the bank, and bank wants that that loan should be covered in case something happened to the customer, and that's what the insurance policy is sold to that customer, so that if something happens, then in that case the money goes to the bank, and the asset, which is a house or a car or anything which the customer has purchased, still remain with the customer. this value of the loan should ideally be the loan outstanding. Let me just go back to the previous part of it. The purpose of the loan insurance is the policy that protects the value of the loan, that is the lender, and against the mishappening of the loan seeker. So the death that is going to happen is going to happen somewhere in between the policy term, or in between the loan term. So the value of the loan should ideally be the loan outstanding. So actually the the insurance amount should be equal to how much is the loan outstanding rather than the full amount of the loan. So what are the risks against which the loan protection should be there? It is one due to the death, and the death due to the any reason. It should not that it is only due to the accident, but it should cover all reasons of death. Disability, if a person is permanently got disabled and does not have a source of income, and through this insurance policy, one can repay the loan. So broadly, these are the risks through which one should covered. For such type of risk coverage, the customer need a term insurance. Term insurance is the policy where when the death happens to the customer, the money is given. I think such type of policy is required, and in particular reducing term insurance. So what is the reducing term insurance? Is that that was I was talking about the loan outstanding. So reducing term insurance is basically it starts with the full loan amount, and as the individual, the customer start paying the principal and the interest, so the principal amount start reducing with the loan, and at say after the 5 year, the loan outstanding will not be equal to the actual loan, but it will be lower. So the policy coverage should be equivalent to that amount. So that's what the reducing term, and such products are generally cheaper than the term insurance, which is for the full sum assured. And that's where there is a benefit to the customer, that he or she will get the reduced level of premium compared to the full term insurance. So how mis-selling is happening? What is the challenge? When customer apply for a loan, the ideal product to protect the loan is reducing term insurance, as I said in the previous slide, from a life insurance company, because a life insurance company price a term insurance policy. Term insurance policy can only be priced by the life insurance company. However, many of the customers are sold either standalone health product or group health product, and that's where the mis-selling is happening. So instead of selling the term insurance, many of the distributors who are basically selling the loans, they are selling the health insurance policy. In health insurance product, the risk coverage is the protection of health of the customer. If I have taken, if I am a customer and I have taken a loan, and if a health insurance policy is sold to me, then it means that my health is covered, not the loan, rather than the loan of the customer. That's where the problem is. The plea taken by the seller is, if the customer is sick, the loan amount will be repaid, and this plea is wrong. Because, but how can the loan amount be paid? If I get sick and the money is invested in the recovery of my health, then how that money will be used to repay the loan? The customer is sick and the money is to be used to pay the hospital bills rather than paying the loan. Most of these health products are sold by the GI companies, that is general insurance companies. The risk of the death is mostly not covered under such health cover, except accidental health. When such health insurance products are sold, maximum to maximum the accidental death is covered and not the full death is covered. It could be, the death could be due to heart attack, it could be due to any reason. This is because the individual term product is not sold by the general insurance companies. Such health product does not meet the need of coverage of home loan from the risk of death of loan taker. Note this point, this is very important, that the policy that has been sold to the customer is a health product, and that health product is not covering the risk of death. So it is covering all other things about the health of the customer except the risk of death, which is the most important for the coverage of the loan. Such coverage of health insurance to protect the loan is a misselling, as it does not meet the need of the customer for the coverage of risk of death. The customer's nominee will be exposed to risk on the demise of the loan seeker. If the if the loan seeker has died, what the nominee will do if the death is not covered due to, say, heart attack? At that point of time, that lady will be exposed to the risk, and the house will be basically, taken over by the bank because that risk is not covered. In 2013, I took a housing loan for 15 years term, and I was sold a single premium health insurance policy for 5-year term covering mostly the critical illness. That time I assumed that the term the risk cover of death is covered in this policy. That was my assumption. My mistake was I did not check with them. I realized after 3 months of purchase, when I read the entire policy bond, that the risk of death is not covered. I reached the bank and cancelled the policy and explained to them about this gross mis-selling. This was a gross mis-selling because they should have explained to me that the death, which is the most important part of the loan, where the risk is, the most of the risk is, that was not covered, and my health was covered. I could have taken health insurance for different purpose. Health insurance is totally a different thing, compared to the loan. In 2024, I took a car loan and I am sold a group hospital cash product that provide a cash benefit to me upon hospitalization. This product has only accidental death inbuilt. So in this policy, if I get sick, I go to the hospital, get hospitalized, the insurance company is going to give me daily hospital cash. What it has to do with the protection of the loan, except the accidental death. The other risk of death is not covered because general insurance company don't cover that. Upon raising the concern with the distributor of the car, I am told that you have given the consent, and the customer, yes, I had given the consent to purchase a loan protection and not to sell anything. And the customer care executive don't understand the difference between health insurance and loan protection. They only understand consent and nothing more than that. I have raised my concern with the CEO of the GI company, and the further conversation is awaited. 10 years apart between 2013 and 2024, it seems that things have not changed. For the loan amount, health insurance policies are still being sold. I think this should be, addressed. Now, for the customer, what one can do. I think regulators are doing their job, but as a customer, like I told you that I have been foxed twice. I have been in the insurance sector for last 30 years. If I can be foxed, I think the people who don't, those who do not understand, or then they will be just foxed. So for all the customers taking the loan should at least cover the risk of death from all causes and not just the accidental death. They should check if the health insurance is being sold. Understand whether you need the health insurance along with the loan cover or separately. That's the point, if check that the loan protection that is given to you is a health insurance or it is a term insurance. If it is a term insurance, it is covering the risk of death. If it is a health insurance, it may be just covering the risk of only accidental death, but still you will be exposed to the risk of other deaths, other causes of death. That's what one need to be careful for whenever you're going for a loan and loan protection is being sold. A regulator IRDA should ensure that insurance company covering loan insurance cover all death risk, not just the accidental one. I think for regulator, what they can do is that any loan coverage that is there, uh, all kind of debt should be covered, and it should not end up only with the accidental death, because in that case the customer remain exposed to the risk of other causes of death. So that's what the summary is coming it out, that the customer need to be careful. The practice is prevalent that health insurance is being sold along with the loan insurance. So be careful, customer. And you can subscribe to my channel. uh, on some regular basis I make a video just to share my thoughts and create an understanding of insurance and the risk management. These are my some of the previous videos on reverse mortgage, flood defense in Pune. So okay, thank you for listening. Goodbye.